Tariffs, inflation, and policy change have taken center stage, fueling market volatility in Q1 2025. But can you turn this uncertainty into an investing opportunity? Up next, we're going to share strategies to help you navigate market fluctuations.
Let's get to PNC Asset Management Group CIO Amanda Agati. Amanda, it's great to see you. You've been hearing what we've been talking about here, this rockiness we've been seeing in the market. I know that you've been watching the volatility very closely. And even though, as Josh said, it's tough to call a bottom, I think we can have a discussion around what is going to help the volatility abate to some extent. What are you going to be watching for signals that things are maybe quieting down a little bit?
Well, it's great to be with both of you. Thanks so much for having me. There's a lot of variables that we should be focused on. I mean, I think the biggest one is getting to some stability or at least some clarity around fiscal policy. It's been the number one driver of market volatility so far this year, and there's been an awful lot of noise. It's hard to discern the noise from the news because it seems like it's one extreme or the other, and we aren't really sure what's going to stick. So from a policy perspective, getting some clarity will certainly serve, I think, to kind of solidify a bottom in the market and frankly, even catalyze a pretty significant snapback if it happens soon. But I think the other thing that's important is Q1 earnings season is just about a month away. I can't believe the first quarter is like effectively over. And so I think from a revision perspective, it's been pretty negative and pretty scary. It's really catalyzed this growth scare narrative that sort of gripped markets. And so to see the rubber meet the road in terms of the earnings growth path forward and the fundamentals actually come in better than expected, I think is a really important catalyst for this market rally.
Yeah, Amanda, this is Barb. I think we're all expecting the Fed not to do much tomorrow. But what do you think the focus will be for the Fed? Will they be focusing more on inflation, given recent surveys showing long-term expectations for inflation are kicking up, or do you think they're going to be more worried about growth slowdown?
It's a great question. We think technical term, it's going to be a snoozer this week, which is a good thing. I think we need a little bit of calm and stability. As much as I might fight the Fed or debate the Fed on any given day about what they're doing or not doing, sitting on pause here and being a little bit more dovish in terms of its narrative, I think is the right path forward. They are absolutely right to be focused on inflation. We haven't won the inflationary battle. There's still some fire in the inflationary backdrop. But as you sort of zoom out from that and look at the landscape, I think we come back to this policy uncertainty. How much is tariff policy or trade policy really going to stick in terms of implementation? If it's narrow and targeted, we can work through this. But if it ends up being much wider in terms of scope, it's anti-growth, it's inherently inflationary, and so the Fed has a right to be worried.
I don't know. I think the horse is a little bit out of the barn with it being narrow in scope at this point, Amanda. But as we know, things can change on a dime, and they do. I want to get back to maybe the next thing that could help the market, and that is the fiscal policy you referred to, because I've been hearing an increasing amount of sort of debate and wondering on that, if there is going to be anything more than just the extension of the 2017 tax cuts. And whether, if indeed that is what it is, if that is enough, if that is what the market wants.
I think it's a great question. It's the thing that I wish that we were talking about more than tariffs or trade-related policy, is it absolutely hits home instantly, right, in terms of what they do with the Tax Cuts and Jobs Act. I think, unfortunately, we've moved way past that, and there's an assumption that it's just going to continue at the level that it's been at, but it's not going to sunset, which is good news, right? In the back half of last year, we were a little worried about which direction this was going to take, but I don't think this is the thing that's necessarily a catalyst. I think it's just steady as she goes. Okay, let's move on and focus on tariffs, inflation, budget, debt ceiling, et cetera, et cetera.
And so, okay, so we've got the backdrop, which is still a little rocky here. What are you thinking? What's your latest thinking in terms of strategy then? Are you getting more defensive?
Oh, no, we're definitely not getting defensive. I mean, this is an environment where we think this is much more about a crisis of confidence, a sentiment hit, a growth scare, than really sort of a material impact to the underlying fundamentals. We came into this year solid from both an economic and an earnings growth backdrop. And so, there's been a lot of noise, a lot of uncertainty, but we haven't done permanent damage yet. So to the extent that we can get a faster resolution or maybe some additional clarity here in short order, I think the path forward can be very positive. And so we're using this correction as an opportunity to reposition portfolios. We're leaning into quality in particular. Some of the Mag 7 names aren't necessarily cheap, but they are certainly cheaper than they have been. And so picking up some of these really attractive long-term secular growers at these valuation levels is, I think, the right approach here. So stay invested, stay well diversified, put some of that capital that may be on the sidelines to work, use this correction as an opportunity.
Sounds good, Amanda, because that was going to be my question. It sounds like you're putting cash to work as we speak.
Yeah, I mean,
that's exactly right. Yes, absolutely.
And it seems like you two are actually somewhat in agreement on this point as well, that even though maybe growth forecasts are sort of ratcheting back, they are not going down. I mean, I guess to ask it another way, Amanda, has the decline that we have seen priced in an already slowing environment to the point where it's been overdone?
Well, I don't know that I would say that it's been overdone, right? Because we still don't know where the end state for some of this policy is likely to land. But I think we certainly have captured the lion's share of it at this point. So, is this effectively the bottom or not? I don't think that's necessarily the case. I think there's going to be a little bit more noise. But I do think that, we came into this year so strong that there is a little bit of headroom and a shock absorber from a growth perspective. What we didn't have was a shock absorber from a valuation perspective. We came in, with a market that's priced to near perfection. The backdrop clearly has not been that. And so that's why I think this correction has been maybe swifter and a bit more painful than what investors would have otherwise expected. But again, the fundamentals are still hanging in there. So we feel good about positioning in this environment.
Amanda, great to see you. Thank you so much.
Thank you.
After the break, Living Not So Fabulously co-hosts John and David Ottenschneider share their insights on how to Trump-proof your finances. Market volatility can be intimidating. John and David Ottenschneider discuss how you can safeguard your personal finances amid heightened market volatility under the Trump administration.
U.S. unemployment remains historically low at 4.1% according to the latest jobs report, but the University of Michigan's Consumer Sentiment Survey found the share of U.S. consumers expecting unemployment to rise topped 60% in the month of March, its highest level in over 6 months. If you're wondering how you can prepare your personal finances for higher volatility under the Trump administration, we have David and John Ottenschneider, the debt-free guys and the hosts of Living Not So Fabulously, here with their tips. Great to see you both. John, what should you do if you're concerned about job cuts and other economic uncertainty?
Yeah, we have some tactical tips here for you to complement Amanda's suggestions. Our first suggestion is to set up a arm's length away emergency savings account. And with whatever amount you can contribute on a reoccurring basis, go ahead and start contributing to that as soon as possible. But the question is, what's an arm's length away savings account? Well, it's one that's not at your current credit union or your current bank, and it has no fancy features like check writing or debit card. You want to try to create somewhat of a roadblock so you can actually say, talk to the hand rather than looking at my wallet when you're trying to buy something that might not actually be an emergency.
And so, David, how can you adjust your spending habits there?
Yeah, so Brad, one of the things that we love is we have some friends over at Price of Avocado Toast podcast. They shared with us one time their definition of budgets, and they say we all really have two budgets. We have our sushi budget and our can of tuna budget. Our sushi budget is when our personal financial economy is doing well. Our can of tuna budget is when it's not doing so well. And so if you are thinking about, or your job has been doged or possibly is going to get doged, focus your spending on necessities. It may be time to put a little bit of a hold on some of that unnecessary spending.
I'm not sure if I was ready for doge to become a verb yet, but here we are. John, how can your credit card help you save?
Yeah, different credit cards have some great tools that you can use. And one such credit card is the 0% on new purchase credit cards. So if you don't have a flush emergency savings account or you've run into a precarious situation, maybe consider getting one of these types of credit cards and consider applying for and adding payment protection insurance or PPI to this particular credit card. And what that'll allow you to do is it'll cover you in case you're not actually able to make payments on time. It's a great way to protect your credit score and reduce some financial anxiety, but you want to investigate the costs first and don't forget that the insurance won't actually cover your entire payment in perpetuity. It'll only cover your minimum monthly payments for a limited period of time.
Well, I suppose that raises the question, David, then if you miss a payment, what should you do?
Well, the most important thing here is to communicate with your credit card companies, especially before you've missed a payment or that payment date comes due. Ask if you can have a waiver of the fee for that missed payment if it hasn't happened yet, or if it's the first time. Then you might want to move to some other strategies, like asking if they have a temporary hardship program that may allow you to lower your payment, lower your interest, or waive some other fees. The other thing is you can ask to have your payment date moved out. We've done this personally. You can move your payment date out so that maybe if you are just running a little bit behind on money and you will be able to make that payment, you can hit it. Probably the last resort here is to look at maybe a balance transfer card that has a zero interest so you can actually reduce your monthly payments.
John and David, thanks so much for taking the time here with us.
Thanks for having us.
Thank you.
And everyone, you can listen to new episodes of Living Not So Fabulously Wednesdays at noon. Consumer sentiment dropped to a 2.5-year low as inflation expectations rose amid President Trump's recent tariff campaigns. The data from the University of Michigan, alongside the recent move to the downside in equity markets, reflect many of the financial anxieties Americans are currently feeling. We want to wade through some of these anxieties and give people some actionable advice to handle their money in this moment. Here with more, we've got financial therapist Amanda Clayman. All right. Deep breath here. Amanda, where should we begin here, especially as there is market uncertainty amid this recent downturn? How do you make decisions about where to put your money in an environment like this?
Ideally, we make decisions holistically as opposed to reactively to some very distressing emotional triggers here.
Certainly. Okay. And so with that, how do we cope with that financial anxiety that naturally arises, and what are some actionable steps?
Yeah, the first place that I really like to begin with people is taking the opportunity to notice how we are experiencing our body. Fear is really, really felt in our physiological arousal system. You may have heard fight or flight as a reaction. And a lot of us, when we hear distressing financial news, go into that fight or flight reaction. So we want to engage the body and speak to the body in the body's own language. And one of the ways that we can do that is with breath. A really great technique is what's called 4-7-8 breathing, where you breathe in, you inhale for a count of 4, you hold the breath for a count of 7, and then you release the breath slowly over a count of 8. And this is a way that we can, even without changing the content of our scary thoughts or changing our environment, we can start to at least begin to respond from a more regulated place.
And so with that in mind, as we're thinking through so many decisions that people hopefully aren't just making by themselves, but talking to their partner with, how can you make sure that those actionable steps are involving that conversation with your partner, with your family members, whoever you have, to kind of try and pour into that and relieve some of that stress from just making the decision in a silo?
Talking to people is a really great way for us to kind of engage a larger brain, if you will, more than just kind of what our own thoughts or our own reactions are telling us. It's helpful, I would say, in ideal circumstances, if we already have a regular practice of talking with some trusted folks. Maybe that's an advisor, maybe that's a spouse or partner, or somebody else who we really trust their perspective when it comes to what's happening in the markets, when it comes to decision making about money. So yes, ideally we have those conversations already in practice. But if this is new, the place that we would really start in being able to bring this up into a topic of conversation is boy, I'm really worried about this situation, or I'm having some scary thoughts about volatility in the market right now. So to frame it not necessarily as what I'm looking for is advice on what I should do with my money, but really like I want to connect with you from a place of what my concerns are, what my fears and experience are. And that can help us to let the other person know what it is exactly that we're looking for.
This also comes back to how people think about their overall career prospects or employment opportunities. And that's something that we've been consistently tracking month over month in prints like the Consumer Confidence Index. And so with that in mind, how can the career outlook factor into making these financial decisions?
It's interesting. I've been in this space for a couple of decades now. And in the time that I've been practicing financial therapy, I feel like the trend overall has been that work is in many ways becoming more episodic. We're having portfolio careers. Flexibility really is a wonderful skill and mindset to have as we approach our long-term career path planning. But that means really going back to the first point, getting out of reactivity. We don't want to just be jumping from choice to choice, path to path because we're stressed out. We want to be able to respond to some of these environmental cues that may be telling us, hey, the economy is trending away from this. We're seeing impacts from AI, for example, and thinking about, is my career path going to be impacted by some of these changes and developments with AI? So we do want to be responsive to things, but it helps when we can track these things over time, really engage with this as an ongoing conversation that we're having about our lives, as opposed to the place where I think a lot of us are coming into it, which is, oh no, there's danger, and I really have to act fast in order to avoid this danger.
Amanda, thanks so much for taking the time here with us today.
Thanks for having me.
With the Fed holding interest rates steady and maintaining its outlook for 2 rate cuts this year, Kevin Mahoney of Mahoney Asset Management advises a tactical approach to investing. Coming off back-to-back 20% plus returns in the market, find out why this strategist is advising to buy the dip, be tactical.
The Federal Reserve holding interest rates steady and sticking with its outlook for 2 rate cuts this year, despite expectations for higher inflation and slower economic growth. Joining us now, we've got Ken Mahoney, Mahoney Asset Management CEO, and Jeffrey Roach, who is the LPL Financial Chief Economist. Great to have you both here with us. Jeffrey, I want to start with you. How are you digesting and assessing what we heard from Fed Chair Jay Powell at the conclusion of the FOMC meeting?
Well, I think I read Powell's comments real similar to how I interpret just this morning's release out of the Bank of England. So it's not just a U.S. problem, it's around the world. I think of it in 2 main risks. One risk is the uncertainty on trade, and the second major risk is the stagflation story. And so it's an issue in Europe, it's an issue domestically. I think looking ahead, you have to look at some of the upper income consumers. Can they keep carrying the economy along like they have the last couple of years? But in some, those are the 2 risks. We've certainly downgraded our GDP growth forecasts really after January's weak retail sales numbers. So we've been under a 2% number for Q1 GDP for a while now. But those are the risks. Certainly a lot to unpack.
So then, Ken, what trade does that initiate? Because the market was initially a little bit bullish after the Fed meeting. Now, obviously, we're seeing stocks selling off. The Fed meeting was a little bit meh in terms of the thesis and takeaway. Where does the market go from here?
Yeah, it's funny you say meh, because you think about it just in context. You say, wait a second, growth is coming down and inflation's going up. We want to reverse that, right? And I can't believe, by the way, they use the word transitory. Are you kidding me? Give the guy a thesaurus. How about temporary? I mean, the word, transitory gives me the heebie-jeebies. Like 21, 22, they said it was transitory and it was sticky for some time. So again, I'm not sure, what happened yesterday should take a major change in portfolio. I think the Fed put is still there, but remember, I've been saying since the beginning of the year, be careful what you wish for. We came into this year, everybody want 2 cuts, 3 cuts, 4 cuts. I said, you don't want any cuts. You want earnings growth, you want a strong economy, and you don't want to see a whole bunch of cuts. But here we are. I still think, especially after this forest fire that we've had the last several weeks, you still want to go with the big names, the Microsofts, the Apple, NVIDIA, kind of the companies that are liquid. That's where institutions are going to come into. And if they're wrong, at least their liquidity, they can hit the bid. So I still think it big is better coming out of this. I think that kind of reaffirms what kind of Powell said. And for our clients, again, we're looking to buy on dips and try to be tactical, because this is not going to be a 2024 where a high tide lifts all ships.
Ken, it's so interesting. And just to follow on that, because some of the calls that we had heard coming into this year, especially in anticipated volatility, was, okay, the new defensive play is technology, but technology has been some of the area that's pulled back the hardest here. And so as we're thinking about it, perhaps you can kind of quell some of our perplexion on that trade.
I'll do my best. So, look, the headlines are the headlines. I mean, the 24/7 nonstop, you can't even keep up with it. No one can keep up with it. But underneath that is this huge AI spend. I mean, we came into the year thinking CapEx spending for the big, hyperscalers would be 20%. It's coming in 25 to 30%. I mean, Amazon upped their numbers from 90 billion this year to 103, 104 billion dollars they're going to spend. Microsoft, 90 some billion. Zuckerberg and company said 60 billion this year and hundreds of billions. So again, this story is getting lost, and the story is still revolving. We're in the middle innings of this AI revolution. So that's why I know it's hard to contrast what's happening from the top down with the headlines, with Powell. But as an investor, sometimes we have to kind of be like that, that horse, and be like, you know what? I'm going to own these stocks. I'm going to own them long term. I welcome this price, and the price is down, not because of fundamentals of these technology companies. Heck, NVIDIA is cheaper than when it was just a couple months ago. The forward PE is around 25. Historically, trades 35 to 40. So this creates opportunities, and that's what we're trying to tell investors, that a lot of noise, a lot of headlines, a lot of swinging around. Be tactical, but big is better, and technology is still going to enjoy this great tailwind.
And be tactical amid the uncertainty. One of the things I'm wondering about, Ken, if you can hop back in here, is whether or not the uncertainty starts to wrap up come April 2nd when we get those reciprocal tariffs. How are you thinking about how that will impact uncertainty?
I'm not sure it will. Look, we're keying off the VIX. There's volatility, and then there's the VIX. Where it was trading at 28 just a couple of weeks ago. That's about 1.7, 1.8% intraday move. Investors want nothing to do with that. I mean, it's a great trading environment. Investors want nothing to do with that.
Right.
We need to see the VIX, like we saw yesterday, come down, kiss 20. It's a little bit elevated this morning.
Yeah.
But I'd like to see in that 14 to 16 range to get more aggressive, where you have kind of like, okay, we're through this. So I don't think April 2nd, by the way, thank God it's not April 1st, April Fool's Day. It's April 2nd. Well, I'm not sure that's going to clarify everything we want Madison, but I think it's going to put us there a little bit better.
Jeff, forgive me. I want you to hop in here, because as an economist, you can give us the view on whether or not that tariff uncertainty wrapping up is going to give us clarity about the path forward for the economy. What are you thinking?
Well, this is certainly a moving target. In fact, we heard that recently from the Treasury Secretary, Scott Bessent, when he was pressed on, okay, what is going to happen? Is this a 25% tariff? And then there's going to be, on top of that, an additional tariffs based on reciprocal strategies. And the unknown is certainly bothering markets. I think we'll get a little bit of clarity as we get April 2nd. I think one of the things that the administration, certainly those that want to continue to take risk on and more bullish views on the markets, are going to say, hey, look, when we saw in Trump 1.0, yes, a temporary pop in some goods like appliances, but that certainly did not last very long. And so I think we're going to work through that. Certainly, as I mentioned earlier, we're going to have to track what the luxury retailers are saying about the middle and upper income households, because that certainly has been carrying the economy along. And if we can continue to see strength in that side of things, that's certainly going to help offset some of the unknowns from the tariff side.
All right, Ken and Jeffrey, thank you both so much for joining us. Appreciate it.
Thanks for watching. Stay tuned to Yahoo Finance for the latest financial news and updates.